I don't know, do dividend or buyback stock. The stock closes the day up 6%. This would trigger us to do the trade for the next time. Conversely, if Tesla announced earnings today, they were awesome, but the stock was only up 2%. In the comparison, in the second one here, we would not enter this trade the next time around. We only enter the trade, at least this study, and we'll see how it does, but we only enter this trade if the last time the stock announced its earnings, the day following the earnings. So if it announced in the afternoon, the next day. If it announced in the morning, that day. But the earnings announcement day and the subsequent market move, if the stock closed that day up over more than 5%, then we did this whole thing. And what you can see is now we actually have something that is realistic for the non-professionals out there. Again, this is not going to give you that consistent, reliable, and predictable income because earnings only happens about 4 times a year. Plus, a 66% win rate is still not as high as I'm used to. But if you must buy options, there's clearly a better time. So just by doing it only when the last earnings announcement resulted in the stock closing that day more than 5% higher, we have way less trades. Right? Like we have like 12% of the time we're actually in the trade. So we can pick our spots. That kind of checks that first one. We have a win rate of 66%. Now we are winning 2 out of every 3 trades, right? Non-professionals can handle winning 2 out of 3 trades, especially when the average trade is an 8.64% return in 2 or 3 days. And the annualized return is like a 50% improvement on what it was before of 725%. So based on just the pure data, again, I want to kind of show everyone how we took this full circle. Buying options sucks because you have 2 things working against you all the time, right? You have to be right on the direction and the timing of that move. If you do it before earnings, you don't have to be right on the timing so much or the pace so much because implied volatility offsets theta decay. Now, just doing it 3 days before every single earnings announcement does show a positive expected return per trade, but the win rate less than 50%, which means you won't stick with it. Same thing with the 7-day. Positive return per trade, but you won't stick with it because you'll be losing more often than you're winning. Same thing with 14 days until the earnings announcement. Again, positive return per trade, but you will not stick with this because you will be losing more often than you are winning. Ultimately, even though those results showed positive numbers, you won't stick with it because they have win rates of less than 50% and you can't pick your spots, which means in order to get these kind of results, you have to do like hundreds and hundreds and hundreds of these trades every single year. So a way to get around that, a way to get a win rate of over 50%, a way to be able to actually pick your spot is to only do this trade if the last time the stock announced earnings, that day, again, if it announced in the afternoon the next day, if it announced in the morning that day, but that day, the stock was up over 5%. Now we have something that you win 2 out of every 3 trades historically, and you have a 50% improvement on the average trade and the average annualized return. So this is way better than anything you'd ever pay for. Any guru, any alert service, any indicator when it comes to buying options. Substantially better because, again, I've taught 6,000 people how to do this. You do need to win more than you lose. And you do need to be able to pick your spots because not everyone has a giant portfolio. So clearly, buying these options, these call options, 3 trading days before a stock announces earnings, only when the last time the stock was up over 5%, that clearly is something that you can do. Again, it's not going to give you the kind of results that we get in the 6-figure salary system, which is like make money every day, make money every week. But if you are one of those people that you have to buy options for whatever, there's clearly a best time and a best approach to going about it. Now let's look at the 7-day. Again, same thing as we did before on the 7-day, but this time, again, we kind of did that extra bucket of did the last earnings result in the stock closing more than 5% higher? And as you would expect, the results are better. So we have about a 65% win rate. So again, winning 2 out of every 3 trades. That's major improvement because if you're winning 2 out of every 3 trades, you can actually stick with something. And then, again, you're really doing only about 10% of the trades you were otherwise doing, which on a 794 divided by 14, you're only doing 50 or so of these a year, which means you don't need a giant account. Right? You only need a reasonable size account to be able to do this because there's only about 50 of these a year based on the fact that we were in a 16, 17 year sample size. So you can do this as a non-professional because you don't need a huge account to only do 50 of these in a year. And you will be able to stick with it as a non-professional because historically you're winning 2 out of every 3 trades. So in the 3-day example, we got a huge benefit. A 50% improvement on the average trade and 2 out of every 3 trades was a winner in the study. Same exact thing on the 7-day. Now, some of you are probably asking, well, what about the 40 day, the 14 day? Well, let me write this correctly because that wasn't written correctly. Now, what about the 14 days before the stock announces earnings? What does it look like? Well, again, like basically what you thought it was if you paid attention during this video, right? The win rate, 2 out of every 3 trades. The average trade, in this case, is about a 25 to 30% improvement. But you're only doing about 50 of these during